So, what can you do when your credit score is too low to get approved for a regular card, but you need a credit card in order to build your score in the first place? Sounds like a trap, but there's a tool built specifically for this, and it's called a secured credit card. And I'm going to break down how it works, which ones are worth it in 2026, and the three mistakes that will destroy your credit instead of building it. So, I am Jordan. Welcome to Credit Able Jordan, where we make credit simple, real, and actionable. Hit the subscribe button so you never miss a video. Let's get into it. So, a secured card works exactly like a regular credit card, except that anywhere Visa or MasterCard is, with one difference. When you open the account, you put down a refundable cash deposit, and that will become your credit limit. So if you put down $200, your limit is $200. The bank will hold that as collateral, which is why they'll approve you even with bad or no credit. And here's why it works. Every month, the card issuer reports your payment activity to all three credit bureaus. Every on-time payment builds your history, and every month you keep your balance low helps your utilization score. That's it. That's the whole engine. Use it, pay it on time, keep the balance low, and after 6 to 12 months, many issuers will upgrade you to a regular card and refund your deposit. So not all secured cards are worth it. Some charge fees that eat your limit alive. Here are the three I'd actually recommend, and always verify your current terms with the issuer before you apply, since rates and features can change. So the first one is the Discover It secured card. There's no annual fee on this. You earn 2% cash back at gas stations and restaurants, up to $1,000 per quarter, and 1% everywhere else. They will match your cash back at the end of year one, and as early as month 7, they will automatically review you to graduate to an unsecured card, and you can get your deposit back. And the minimum is $200 on that. Number 2 is the Capital One Platinum Secured. So if you can't come up with $200, Capital One lets qualified applicants start with as little as $49 for a $200 line of credit. There's no annual fee. After 6 months of on-time payments, they automatically consider you for a credit limit increase. And then the third option is the Chime Credit Builder. And this is good if you've been really turned down everywhere else. There's no credit check on this, there's no annual fee, and there's no interest. It does work a little differently from a traditional card. You transfer money in, and that's your spending limit. So there's no balance that you need to carry and no interest you need to pay. You do need an account with Chime in order to open it, because it is not a revolving account. It won't build your credit mix the same way. But for someone that has been turned down everywhere else, it does get you on the board, and it does report to all three bureaus. So real quick before we get into the mistakes, if you've got collections, errors, or late payments that are dragging your score down on top of a thin credit file, then a card may not be enough to move that needle. So I've got affiliate links down in the comments, and these companies can help you build your credit, clean up your credit, and once your credit is solid, they can connect you with business funding options. So again, links are down in the pinned comments. Now let's get into the mistakes. So mistake number 1, maxing out your credit card. So utilization is 30% of your score. If you charge $180 on a $200 card, you're at 90%, and that will hurt you. Keep it under 30%, so on a $200 card, that's no more than a $60 balance max. Mistake number 2 is carrying a balance. So the secured cards will carry APRs of 25 to 30%. You do not need to carry a balance to build credit. That is a myth. You can pay the full balance before your statement closing date every month. Again, not on the due date, on the statement closing date. That's when your balance will get reported to all three bureaus. And mistake number 3, closing it too soon. Once your score improves, don't close it just to clean things up, because closing it will shorten your credit history and removes your available credit, both of which can drop your score. So just let it run. So your action plan, you want to pull your credit report, pick the right card, and make small purchases on that card every month and pay it before the statement closing date, and don't close it. So please subscribe for the next video, and you can drop a comment and you can let me know, are you building from scratch or are you building after damage? Again, I'm Credit Able Jordan, and please take care. Have a good one.